Management's discussion and analysis, MD&A, in details. Management's discussion and analysis, MD&A, is a section of a company's annual report or quarterly filing that provides a narrative explanation and analysis of the financial statements and other key aspects of the company's performance, operations, and financial condition. It offers insights into the company's past performance, current position, and future prospects, helping stakeholders better understand the financial results and trends. Here are the key elements typically included in the MD&A section. Overview of operations. This section provides a high-level summary of the company's business activities, including its main products, services, markets, and competitive landscape. It outlines the factors influencing the company's financial results during the reporting period. Financial performance analysis. Management discusses the company's financial performance over the reporting period. It highlights significant changes in revenue, expenses, and profitability. Management may explain the reasons behind these changes, including factors such as market conditions, pricing strategies, cost management, and currency fluctuations. Liquidity and capital resources. This part focuses on the company's ability to meet its short-term and long-term financial obligations. It discusses cash flow from operating, investing, and financing activities, as well as any significant changes in the company's capital structure, debt levels, and borrowing capacity. Critical accounting policies and estimates. Management explains the key accounting policies and estimates that significantly impact financial statements. These policies can include revenue recognition, inventory valuation, depreciation methods, and other accounting practices. Management clarifies why these policies were chosen and their potential impact on financial results. Risk factors. This section identifies and discusses the main risks and uncertainties that could affect the company's future performance and financial condition. It addresses both internal and external risks, such as regulatory changes, market competition, economic conditions, and technological advancements. Segment analysis. If the company operates in multiple business segments or geographic regions, management may provide an analysis of the performance of each segment. This analysis can help stakeholders understand how different parts of the business contribute to overall results. Forward-looking statements. Management may provide forward-looking statements that outline the company's expectations and projections for future performance. These statements are accompanied by cautionary language highlighting the inherent risks and uncertainties associated with future events. Non-GAAP financial measures. If the company uses non-GAAP financial measures, metrics that are not defined by generally accepted accounting principles, management explains why these measures are used and provides reconciliations to the closest GAAP measures. Auditor's report in details. An auditor's report is a formal statement issued by an independent external auditor after they have conducted an examination of a company's financial statements and accounting practices. The report is included in the company's annual financial statements and provides stakeholders with the auditor's opinion on the accuracy and reliability of the financial information presented. Here's a detailed breakdown of an auditor's report. Report title and addressee. The report typically begins with a title, such as, Independent Auditor's Report. It is addressed to the company's shareholders, the board of directors, or other relevant parties. Introductory paragraph. This section identifies the financial statements that were audited, including the balance sheet, income statement, statement of cash flows, and notes to the financial statements. It specifies the dates covered by the audit, usually the fiscal year end. Management's responsibility. The auditor's report outlines the responsibility of the company's management for preparing the financial statements and maintaining internal controls. It emphasizes that management is responsible for selecting appropriate accounting policies and making accurate financial disclosures. Auditor's responsibility. This part explains the auditor's role, which is to express an opinion on whether the financial statements are presented fairly in accordance with the applicable accounting standards. The auditor conducts the audit in accordance with generally accepted auditing standards, GAAS, or international auditing standards. Audit scope and procedures. The report describes the extent of the audit procedures conducted by the auditor. It provides an overview of the audit approach, including the examination of evidence supporting the amounts and disclosures in the financial statements. The basis for opinion. The auditor's report states that the audit was conducted to obtain reasonable assurance about whether the financial statements are free from material misstatement. It explains that an audit involves assessing internal controls, testing transactions, and evaluating accounting estimates. Auditor's opinion. The crux of the report is the auditor's opinion on the financial statements. There are three possible types of opinions. Unqualified opinion. This is the most common opinion and indicates that the financial statements are fairly presented in all material respects. It provides stakeholders with confidence in the accuracy of the information. Qualified opinion. A qualified opinion is issued when the auditor believes that the financial statements are materially accurate except for a specific issue. This could be due to a limitation in the scope of the audit or a departure from generally accepted accounting principles. Adverse opinion. An adverse opinion is rare and indicates that the financial statements are not fairly presented due to material misstatements. This opinion raises significant concerns about the accuracy of the financial information. Disclaimer of opinion. In some cases, the auditor may be unable to express an opinion, often due to limitations on the scope of the audit or insufficient evidence. This is referred to as a disclaimer of opinion. Signature and date. The auditor's report is signed by the auditing firm or the individual auditor responsible for the audit. It also includes the date of the report, which is usually the date when the audit work was completed.